Is regional Queensland still one of the top performers when it comes to capital growth?
Looking at Queensland, strong population growth, strong improving economy. There is not a lot of in simple terms, and the transactions are flying off quickly.
Founder and head of research for Investorkit, Arjun Paliwal, is here to assess an area that you guys have sent in.
Vacancy rates in Gladstone are 0.9%, so extremely low. So the percentage change is the big thing on days on market, not just the actual figure. Your 1 year data has already outperformed the 10 year data. Gladstone has had a 10-year growth cycle, and check this out.
If you've been thinking about investing in Queensland, or more specifically in Queensland's regional cities, you're going to enjoy this episode. And if you want the chance to have a location pulled apart by one of the leading data experts in the country, click the link in the show notes below and send it in. My name's Todd Sloan. You're listening to the Pizza and Property Podcast, and this is my chat with Arjun Paliwal. Arjun Paliwal, how are you, mate?
Good, my friend. Great to be back.
Mate, it's always good to have you here. We're talking data, listener's choice.
Yes.
We've got a question that's been sent in by Rade, and I want to say Rade and Rob because the email is from Rade, but then the text message I think looks like it's signed off by Rob. So Rade and Rob, it's time to ask your question. So the area that we're looking into is Gladstone. So we're looking Queensland first, then going down to the LGA, then going down to Gladstone itself. But the actual question is, how does Gladstone rank against other regional investment areas in the 450 to 550 range? This is a proper question here. With 5 to 10 year investment horizon, noting that this is the second investment property purchase. Time to jump into Queensland.
Yes. So looking at Queensland, strong population growth, strong improving economy. So if we're looking at the population growth, interstate migration, overseas migration continues to improve. Unemployment rate quite low as well at that 3.8% mark in terms of the most recent data. And ComSec's job market. So we've mentioned this before, like the job increase has been really quick. It's had the fastest job rate growth at up 4% in the July 2024 edition of ComSec State of the State. And I think from that perspective, wages, jobs, unemployment, population, that's a few different metrics of measuring it. Not the only. Obviously, we can look at infrastructure spend per capita and things like that. But overall, it's looking pretty healthy in Queensland.
Okay, so as a state, things are looking pretty good.
Yes, that's the one.
Okay, and because they've also had a lot of like tax revenue come in from, is it gas or there was something that happened recently when I was talking to Dr. Cameron Murray about this, and they were basically saying about this is why Queenslanders, everyone got given like these huge paybacks on their power bills or something. I think a lot of states got given like $300, and if you lived in Queensland, you got like $1,000 rebate, and it was basically just Polly's trying to like buy the election or something.
Look, I wouldn't put it down to that. I think when someone just puts it down to a singular source of economic strength and that's everything and anything, I think that's a bit silly.
Yep.
That's just my opinion. I'm of the opinion that you got to look at it holistically. Job advertisements, you got to look at unemployment rates. We look at infrastructure spend across private and public infrastructure. We're looking at that spend on a per capita basis. We're also looking at people movement. Just chucking some energy back into someone's pocket doesn't make a whole bunch of people move over. Doesn't make a whole bunch of jobs get created by private institutions. Doesn't make a whole bunch of infrastructure get created by private institutions. Obviously, the public force is a major arm. I'm going to say it isn't, but I think it's quite holistic.
I think I was referring more to just the fact that they have more money to splash around at the moment because of this new revenue. It wasn't so much that it went into giving someone $1,000. You're right. No one's moving into state for $1,000.
Yeah.
But is that something that is a bit of a factor in it, that they're getting a lot more like income as a state versus some of the states that are like in quite bad debt at the moment?
It's hard to say because the thing is how people got into debt is also spending. So that means people were spending and didn't have the money and decide to still spend.
Yeah, it's not like a state just buys lots of TVs on Afterpay.
Yeah, So I think as a result, like people can still spend even with a weak economy because they can just print money and they can continue to do these things and they can go into debt, right? Like debt itself is a thing that they're just creating from what they decide to invest in or how they decide to move things, and then they put up taxes at some point to pay that back, right? But the main thing is, like, you see states that have invested a lot in stuff and they've been able to go into deep debt and then now they're clawing it back, like Victoria. And then you've seen other states that you might say, hey, well, their performance has been high during mining booms and mining increases and therefore they can now reinvest, but they don't reinvest as much as they should. And so as a result, I wouldn't put it down to just how they're performing, therefore is how they're spending. I would still say that there's been low performers who've spent high. So from that perspective, I'd just say looking at it holistically from a jobs point of view, it's improved. Looking at it from a unemployment perspective, it's improved. And sure, they could have flow-on effects like that spending you're talking about, but I haven't looked into that too closely.
But overall, Queensland as a state, it's
healthy.
good. Wow.
Absolutely.
Okay, and now if we go Gladstone, now normally we break this up as like LGA then suburb, but this is kind of like talking about the town of Gladstone. How do you want to break this up?
Look, I'll just stay in the LGA of Gladstone and talk about it as a whole because, the suburbs might be a stone's throw away from each other as well. It's not a huge town. It's still pretty active, but not a huge town. It's got a lot going on for it, right? If I start off by why someone might be attracted firstly, is Gladstone has had a 10-year growth cycle, and check this out, where it's only moved up, actually it's moved backwards by 2.3%. And so if you're using what we call APM data, which is domains data source here, Gladstone's today price is cheaper than Gladstone 10 years ago by 2.3%. Pretty crazy, right? So when you have that as a starting point, you could argue that it's got a lot to catch up. But we don't use weak growth in isolation as a way to say, therefore it must grow. Something's got to give, something's got to change, because if it's weak growth and all the factors that were there to create that weakness are still there, then you can't just say it's going to shift.
You want to find out what that something is.
That's it. And here's the something. We've actually got a few things going on for it. So firstly, vacancy rates in Gladstone are 0.9%, so extremely low. Gladstone's also very affordable now as the rest of the state has grown a lot, with Gladstone's median price at $430K. You compare that to somewhere like Brisbane, which is edging close to $1 million, big difference. Gladstone's yield is very high. I know the costs might be high too in some insurances or other things like that, but their rental yield's at about 5.8%. So in high interest rate times for affordable buyers looking for a bit of a cushion, that kicks in. Now, 1 year price growth, 5.1%. So that's something changing. I know 5.1 might not seem a lot, and it's below the 12-month national average of 8%. But 1 year at 5.1, when the last 10 years has been minus 2.3, your 1 year data has already outperformed the 10-year data. So something clearly is changing. And then if you overlay that more and more, building approval percentages at 0.99%, so extremely undersupplied from
basically
building.
Non-existent.
Pretty much. We've got 1 year rental growth at 9.1%. So that's strong rental growth. Those are the pressures coming in from a living and shelter where rents are a quick moving data point to show you that change.
What about population?
Our population's been healthy as well. So it's about 2.15% year on year growth. It is lower than what Greater Brisbane's seen, but still healthy. And unemployment rates have been on the higher end at 5.9, above the state average, but still healthy. It's not like it's, 10% or 11% or something like that, which I believe it's gotten to some pretty high levels in the past. And here's the key part. Inventory is down a lot. It's 1.6 months of stock. And that means there is not a lot of stock in simple terms. And the transactions are flying off quickly because days on market's now at 69 days, which is actually quite low for Gladstone's history.
I was going to say, that's not low in comparison to some other state or areas, but
That's
for Gladstone,
right.
That's low, isn't it?
Very low for Gladstone, and it's declining 20% over the last year. Now, that 69 days is a figure that can be a bit funky because in Gladstone, there might be many suburbs where some just have properties sitting there for 100 days.
Yeah.
And then they might be impacted for many things. Then the properties that aren't impacted by anything sell in a week. And I can tell you right now from our local observations and understanding, things are selling within days or a week. So that means this market's really starting to pop off.
The thing that I always find interesting about days on market as well is the way that it's actually measured locally.
Yeah, it's lousy.
Yeah, because some agents I know that as soon as it's under contract, it's like, bam, like that's it. We'll show that as under contract. But I know that the firm that I used to work for, it was once it was unconditional. So you could get a property under contract, but they have a 3-week finance clause and it was showing up as still 21 days. And it's like, well, that's not really accurate either. And if
Absolutely.
everyone's slightly different, then it sounds like this 69, as much as this has come down from probably like a triple figure days on market as an average, it's not really a true representation like you're saying.
Yeah, it's never a true representation. What I would always say is you look at the percentage change and you look at the history of that city. So I'll give you an example. Tamworth is another city where we predicted some years back that it would boom, and it did really, really well post-COVID. And when we saw that boom that happened in Tamworth, the days on market on some stats was showing like 160 days and 180 days. And I found it really interesting that in Tamworth, you'd have the listing online and buyers wouldn't exchange contracts until they'd done BNP, until they'd done finance, until they'd reviewed everything, and they'd sign on like offer terms sheets. And that was really interesting to see. So what ended up happening was the listing could go on for 2 to 4 weeks, and there might have been multiple deals being made simultaneously with pest and building finance taking play. And then all of a sudden the contract gets signed on the 4th week once everyone's happy with everything, and then it goes through with a very short term. And so all of a sudden, like, you're losing about 2 to 4 weeks before a sale even goes on. Yeah, it was really weird. I found that interesting. But it worked for them. It was what their city did and what maybe the agencies I knew of did. And it still performed because it decreased a lot from what they used to have. So the percentage change is the big thing on days on market, not just the actual figure.
And this is really stressing the importance of the data is obviously important, but it's also understanding how that data is put together that can make the world of difference as well.
Yeah, get local, because if you look at that figure and go 69 days on market, that's really high. Why not just call a few agents? Why not look online for a few properties and inquire about them a week later? And just let that be your guiding force, because that can tell you that these metrics are funky.
Yep.
Or it can tell you that, hey, the metric itself might be funky. 69 days isn't really that. But the declining percentage is legit because I'm calling people and things are going really quickly.
I like it, man. So as far as the question around this being a second investment property around that kind of, like, was it 400,000 to 500,000? I think they were asking. Is this a no or a go? Because I'm so bad at pegging this. Sometimes I swear you got to go one way and you surprise me.
This is a go for me, right? So if you're looking at this portfolio, looking at affordable pricing is your budget requirement.
Yep.
And you've got an affordable market.
Okay.
You've got extremely tight stock. You've got a 10-year growth cycle where you haven't missed out on much. You've got a tight rental market. And you've got a strengthening economy. The only downside of the city is it has to have an asterisk. The asterisk is that the economy itself is not very locally diversified. And so what that means for you is that you're going to have a great run because all the data suggests it. And it will do well. But you cannot sit there thinking that those times that happened in the past can't return again. Because if the prices were what they are today from 10 years ago, they happened because of economic expansion and contraction, and a couple of industries felt the brute force of that contraction, and the whole city demonstrated it. So that can happen again in the future. It may not happen, may never happen if other jobs keep on popping up, but just assume it can. And so if you make that assumption, you go into a property in your portfolio saying, I'm happy with this, I think it's going to do well, all the numbers suggest it, great, but I'm prepared for the scenario that if it does happen, and how do I prepare for that? Buy other properties in other markets, diversify.
As far as its economy is concerned, because I'm hearing what you're saying now, and it's sounding like this is a great place that you've got a low buy-in price, hasn't done anything for quite a while, you're early in the cycle, but it's still, the runs are showing that they're about to start appearing on the board. Your yield, I don't actually think did we discuss yield?
Yeah, yield's healthy. We did. It's 5.8%.
Okay, so very strong yield. So as far as local economy is concerned, is it like super mining reliant, or is there, because that seems to be the tipping point for you of like, watch out for this. Like you said, that's the asterisk.
Yeah, mining, gas, those two seem to be a fair bit of the industry, a lot of gas projects all around. So things can shift. And also there is infrastructure with renewables coming in. And with those renewables, they're very construction top heavy. So at the time of making these projects, they're very heavy on construction, which can constrict rental supply, which can have people thinking of buying up there, whether it be local to live in, invest. So I think like those industries can dominate and then all of a sudden shift. Doesn't mean that like these property prices return to 400K and it becomes the only town in all of Australia with 400K prices. I very much doubt that 10 years and 20 years from now, the property prices are staying at 400. But what I would say is that you're in a position right now where all the data is looking good. I just wouldn't want you to go and buy this thinking that this is your home run forever.
Yep.
I would say that this is a piece in your portfolio and it's going to do quite well over the next 5 years. But whilst this piece does well, insulate yourself because there's an asterisk in the economy of this market, and insulate yourself by having assets in other markets. For
Rade and Rob, for a second property, go for a second property as well, or still like, oh, maybe it was your third or fourth?
Look, it'd be a go for me if they're in a position to strategize, plan for their third and fourth.
Gotcha.
And so that would be my thinking there. So then you've got 1 out of 4 pieces in a town that has that downside to it. You've got money in offsets. You've got, equity. You've got assets that are in different states. And that just helps you insulate it quite well, because I always like portfolios when you have an asset in a certain location, it does well, it calms down. And then just when you think the rest of the portfolio is doing nothing, another property in your portfolio does something and it calms down. So I always have been a fan of that, which is why myself, I'm across 5 states, just because I think that that's important to have.
Love it. Rade and Rob, I hope that's answered your question. And if you guys have got a question you want answered by Arjun, make sure to click the link in the show notes below. Give us as much detail as possible. Rade and Rob gave us heaps, so it could be way more specific when Arjun's actually tailoring an answer for you. But otherwise, is there any other final words of wisdom or anything you want to chuck into this episode, Arjun?
No, I think firstly, good on them for picking up areas like that from their own view and guidance, because if they've picked that and they've come to us with this sort of question, it means they got to that city, right? Because it's not a city you hear about often. And so to get to that's a great thing on their part. And it's now just about using this analysis and that risk management I've shared about. Like if you can have best of both worlds, then it's a winning combination.
Love it. Arjun Paliwal from Investorkit, thank you so much for jumping on the show.
Thank you, man.